Hello, everyone. Welcome to today's webinar. I'm very excited about having everyone here. My name is Liz. I am the co-founder of InvestHer, and we believe it is a woman's birthright to become financially free. That is what we stand on, and that is why we are here doing different types of trainings around growing yourself, growing your business, or growing your portfolio. And I know we're going to be touching on probably all three today because you can't really be able to be a powerful real estate investor if you're not continually have more tools in your toolbox when it comes to working with lenders and really thinking like a lender and structuring deals that way. So before we jump in, Jacqueline, thank you so much for being here. Jacqueline is with us,
Thank you for having me.
CV3, one of our preferred partners, and we'll be there at Investor Con.
Yes, definitely. So if you haven't registered, make sure you register.
Yes, yes. So I'd love to hear in the chat box, because this is not just a dormant webinar that we're doing. This is a live training. You've put time aside. Time is the one limited resource that we have in this wonderful universe that we have. So we really want to take that seriously. Would love to hear, number one, where you're calling in from, because we have a network across the country. Jacqueline, where are you again?
I'm actually based in Las Vegas, so I'm in Nevada.
Okay. So after this,
Yeah.
she's going straight to the slot machine. No, I'm joking.
Yeah.
The
If you
place.
guys are ever in town, definitely reach out because I know a lot of people come out here for business and for personal reasons.
Yeah, Las Vegas is one interesting place. But would love to put in the chat box where you're calling in from, and also where are you? What is your intention for being here with us? Because so often people join different sessions, different webinars. At InvestHer, we really, really want to encourage you. When you jump onto a training, go in with an intention. Go in with something very clear that you want to get out of it. I know Jacqueline's going to be going through deals. She's going to be going through a lot of numbers, which is exciting because that's where you kind of get your hands wet. I love that. I love that. And I think women are amazing at numbers. And once we get more confident in what we're seeing and what we're, on these deals, we can really make those better decisions. So in the chat box, where are you calling in from? Hey, I just want to say hello to everyone here. Jardev Zaz.
Jaritza.
Jaritza, thank you.
Yes.
Jaritza, thank you. I'm butchering your name, but thank you for being here. That's what I was trying to say. Hey, Katie from Orlando. Katie, you better be at Investor Con. I'm gonna come find you, Katie. So you better be coming to Investor Con now. Joking. Great to have you here. Hey, Jeannie. Hey, Hannah. Good to have you on,
I
Kimberly.
love it. It looks like it's a very active group.
Los Angeles, very cool. Little Michigan. Also, hey, Marcia, good to see you here. I haven't seen your name in a while. Great to have you on. Hey, Sylvia, one of our Strive members. Awesome. So good representative group in terms of Knoxville, one of my favorite places, Kim. Thank you for being here. If you're new to our community, if you could just put new in the chat box, I just want to say a very special new. Awesome. Good to have you guys on. So we are here for you, and our mission is to serve all of you, growing yourselves, growing your portfolio, growing your business. So without further ado, I'm really excited to have you on, Jacqueline. I've seen Jacqueline really active in our community, our real estate InvestHer Facebook group, and as we migrate into InvestHer Plus, which is going to be a very active platform for women to give and get support. Jacqueline's jumping in and definitely an enormous resource. So excited to have you here. What you're going to be diving into structuring deals, which is probably my favorite topic. So thank you for being here. Without further ado, I'm going to give you the floor. I'll be here to support, field questions, but everyone have that intention and take notes and be active while you're here. Turn everything else off.
Yeah, and if you want also just you can grab a calculator too, because we are going through some calculations. At the beginning, it might be a little easier, but towards the end, we do go through a couple calculations back to back. So hi all, thank you so much for joining today. We hope you're excited to hear more about structuring your deals using a private lender. I'm Jacqueline Gonzalez, but feel free to call me Jackie. I'm an account executive at CV3 Financial with over 10 years of experience in investment property financing. Throughout my career, I've helped hundreds of investors structure real estate deals, scale their businesses, and gain a solid understanding of financing strategies. In this presentation, we'll explore various financing structures and how working with the lender can support you and your path to successful real estate investing. Feel free to drop any questions in the chat. I can't wait to share this information with you, so let's go ahead and get started. We're going to go through some real life scenarios and transactions, including a DSCR rental loan and a fix and flip loan. By the end of the presentation, you should know how to calculate debt service coverage ratio, DSCR, loan to value, LTV, loan to purchase, LTP, loan to cost, LTC, and loan to after repair value, LTARV. Understanding these terms and knowing what lenders evaluate is key to analyzing your next potential deal and will help you determine if it's a good fit or if it's a pass. Let's first start with our long-term rental loan. This loan is to provide an alternative to a conventional loan and secure financing long-term. Properties here are meant to be turnkey and rent-ready if not already rented. When would it make sense to use it? One of the most common usages is doing a cash-out refinance after a property has been rehabbed. Typically with conventional financing and other products, there is a seasoning requirement, also known as a required hold time to pull cash out. However, there are lenders that will do a cash-out refinance without a seasoning period, like us, so long as rehab was completed and value has been added to the property, which is why this program is very popular with BRRRR investors. It's also great to use on purchase transactions or as an alternative to loans where your personal income is used to qualify for the loan. In this case, the property's actual rent or market rent will be used as the qualification metric. The biggest hurdles for qualifying are ensuring that the property is truly turnkey or already rented, and that the income or market rental amount will be high enough to qualify for the program. Unlike short-term loans, these loans are designed for long-term holds, so let's go ahead and dive deeper into these specifics. So our long-term rental loan is also known as a DSCR loan, debt service coverage ratio. This case study here is a purchase of a property in Ohio. One of the factors for qualification is experience. We can help with new investors. However, experience does come into play for a more favorable rate. In this case, she has over 3 investment properties owned in the last 3 years. Her strategy is to acquire a stabilized property to add to her portfolio and increase her overall cash flow. Now, here are our loan details. We can see that our purchase price is just about $379,000. Our total loan amount is $284,000, putting our LTV at 75%. Now, the client qualifies for 80% here. So why did she opt for a lower LTV? LTV is one of our key factors that can impact your interest rate. We'll go into how this calculation works later in the presentation, but here's what you need to know for now. When your LTV is higher, it means you're financing more of the purchase price and putting less money down, which typically results in a higher rate. On the other hand, when your LTV is lower, you're putting more money down, which is considered less risky for the lender. That is why there's usually a favorable adjustment to your rate when your LTV is lower. I'm also including her expenses here so that we can see what costs she'll have. Again, unlike conventional programs where a borrower's income is used to qualify for the loan, on DSCR, a property's income or potential income will be used to qualify. So how is DSCR calculated? There are 3 simple steps to figuring out DSCR. Please keep in mind that lenders may calculate their DSCR differently, but at CV3, we use gross income and common expenses, insurance, taxes, HOAs, and monthly payment. So our first step is going to be to determine our monthly expense. We're going to take our insurance, our taxes, HOA if we had any, and add that up to get to a total of $10,692. To determine your monthly expense, you're just simply going to take that figure and divide that by 12. and you'll arrive at your monthly expense of $891. Our second step is to determine the monthly PITIA, which is short for principal, interest, taxes, insurance, and association fees. So we're going to take our figure from the last screen, the $891, and add that to our monthly payment of $1894 to get our PITIA of $2785. Now, if you don't know what your monthly mortgage is, number one, your lender should be telling you, but if you wanted to calculate it on your own, there are a ton of calculators available online. I personally like Zillow. So let's go ahead and open this. And you can see the URL here. But our purchase price we can see is $379,900. We were at 75%, which means they're putting 25% down. And then the final item that we have to do is just update our interest rate to get our monthly payment of $1894. And you can see that that matches. So just a nice little tool for you guys to have. I should say for you ladies to have. Okay, and then our last step is to calculate our DSCR. So we're going to take our gross operating income of $5,000 and divide that by our PITIA to get our DSCR, which in this case is 1.795. Now, if this number here is below 1, it means your property is already operating at a loss. If it's right at 1, it means it's breaking even, and above 1 means it's generating income. Now, most lenders will want to see a 1.0 ratio, which means you won't be operating at a loss. Again, each lender is different. Some might include additional expenses like management fees, vacancies. So be sure to ask your lenders questions. Before we go into the presentation, are there any questions?
Yeah, there are. I'm just gonna field a couple.
Okay.
I have it on the screen. Okay. Michelle is asking, does the investor need minimum trade lines along with a specific FICO score range to qualify, or just the FICO score?
So our minimum FICO score for this program is 660. We don't have a minimum trade line requirement, but we do want to at least pull one score.
Okay. I hope that helps, Michelle. Let us know if not. And then, hey, dear, good to see you on, dear. She is asking, how long is the typical seasoning period before a cash out refinance?
So if you've added value to the property, if you've rehabbed the property, there is no seasoning period. You could essentially refinance using the new value 30 days after purchasing.
Got it.
A lot of
do you,
lenders require like 6 to 12 months. So that's another really great question to ask your lender.
and Jacqueline, I'm sure, Janine, I am really butchering names today. I'm so sorry, everyone. What is wrong with me? What am I drinking here? No, I'm joking. She's asking, do you require proof of income from employment?
We do not. No. So there is no personal income qualification for this program. That's what makes this program so great, is that we're just using the property's income. So as long as you're above a 1.0 DSCR, you can qualify.
Does it matter, especially when you're considering this as an option for investors, or considering this as an option? Does the property itself need to be a bit seasoned, meaning it has to have past rental history? Does that matter at all? Or it could be a new rental?
It could be a brand new rental. It
Okay.
doesn't even have to be rented. So we can help you as soon as you've completed renovation, or if we're coming in on a purchase and the property's turnkey, we can help you while it's vacant. Now, that's another great question to ask your lenders, because some of them do have occupancy ratio requirements. So like, let's say you were purchasing a quadplex, right? And 2 of the units are vacant, but 2 are occupied. They might want to see at least 75% occupancy, which means you would have to get that 3rd unit rented before you could qualify. But with
Makes sense.
us, as long as it's the market rent, like we can use the market rent if it's vacant. And as long as that qualifies for that program, we're all set.
And Elizabeth, I just asked that question. I didn't even see your question. So it's probably because we have the same name that we're asking the same questions. But with this particular product for investors, what is a common mistake that investors make when they're considering this type of program? Meaning, like, what should they keep in mind if they're considering this and they're presenting it to a lender? What should they keep in mind and avoid?
I would say just really make sure that your property is again turnkey. I mean, that's like the biggest hurdle that I've seen is someone wants to buy a property and they low key plan to do renovations, but they try to avoid saying that. The thing is, we're going to do an appraisal, we're going to see the property's condition, and if it's not habitable, then we're
Yeah,
not going to qualify for the program. So it's best to just be upfront with your lender, and just be honest with yourself too. As much as you might want to do a 30-year loan, if the property doesn't qualify, we're going to have to go into like a shorter term option, which we'll also go into. So with us, you have different exits. We don't just
yeah,
do one or the other. We can help with both.
I like that. Joanne's also asking, can you go over the calculation of the DSCR ratio of 1.7595? Just go over that again, how you came up with that?
Yeah, so we just divide the gross operating income, so the 5,000, by the PITIA of 2785, and then you get your DSCR of 1.795. And then I think you're also going to distribute this presentation afterwards as well, right? So
Correct.
you can feel free to re-watch this as many times as you need to. The other thing too is if you have a particular scenario you want to go over, I am more than happy to hop on a call and go over that in detail with you.
And then Kim's asking, got a lot of questions here. Kim is asking, do you apply for the DSCR to purchase the property or only to refi?
So we can help on a purchase transaction and on a refinance. I'm not sure if I understood that question correctly, but you could do both.
That's what she's asking. I'm assuming. Yeah. That you can use this program for either a refi or a purchase.
Yeah.
I've also, and I know I'm throwing another question out, and I know I've asked you this question. Some women have asked about a business HELOC, doing a home equity line. And this might be another thing you're going to get into, but I'm curious to hear your perspective on that. When people want doing that or doing a cash out refinance as another option.
Yeah, I mean, what's great is with the HELOC, you can reuse those funds like multiple times. My understanding is that the interest rate might be a little higher. Um, so with this program, it is a lump sum and it is a long-term loan. So this is a 30-year loan.
Yeah. Yeah.
With HELOCs, they tend to be shorter from my experience.
Gotcha. Okay, cool. Yeah. Great questions, everyone.
But what I do want to add is to your point, if someone's doing like a HELOC, they can combine it with like a DSCR loan or a short-term bridge loan to really leverage their cash.
And then one other quick question before you continue. What are the prepayment, penalty terms? So what are the prepayment penalty terms?
Yeah,
If,
so it'll range. You can get no prepay, but the most common form of like quoting is, especially now with higher interest rates, is a 5-year prepay. So you can get no prepay up to a 5-year prepay. But the shorter your prepay is, the higher your rate's going to be.
I love the women. They're asking a lot of questions today. I love it.
Good.
And I love the question, dear. We've trained you well. Are points negotiable?
Points are negotiable. They will depend on like experience. And so that's something that you'd want to talk to your loan officer about. But keep in mind, every lender is different. So that's the number one tip that I can give you guys is just ask your lenders questions.
Yeah. And I'd also add to that, every lender has a different appetite for different regions, different types of products, right? And so it's not all things are not created equal when it comes to lenders. So
Yeah. And the other thing too, and since you mentioned regions, we're actually nationwide. So I think we can help with either all, if not a majority of the different areas that the ladies are investing in. Is that it for questions?
that's it for now.
Okay, perfect. So I just said this, but one of the best tips that I can give you is to ask your lenders questions. Many lenders have what's called a seasoning requirement, meaning you must be on title for a certain period before qualifying for a refinance or a cash out refinance. However, some lenders offer more flexibility. If you've made improvements to the property, they may allow a cash out refinance based off of the new appraised value, regardless of how long you've been on title. So make sure to ask your lender about this. Okay, now that we've covered long-term rental loans, we're going to look at short-term bridge loans. This loan is designed to help provide a quick financing solution, whether it be a purchase or a refinance. When would it make sense to use it? There are several reasons why someone would opt for a bridge loan. However, the main usages are to quickly to acquire a property, to fix it up and then sell it, or fix it and then hold it. When a property's condition isn't habitable, it may not qualify for conventional products. Other times, people themselves don't qualify for conventional financing, whether it's a DTI, debt to income issue, credit issue, or paperwork issues with not having tax returns in order. Even though this program is mainly seen being used on a purchase of a property, this could also be a great option for a short-term solution on a refinance. For example, if you purchased a property, added value to it by rehabbing it, and tied up your cash, you may want to refinance to get your cash out to purchase another property while this one takes a few months to sell. That way, a new opportunity doesn't pass you by and you're turning over properties as quickly as possible. In short, the bridge loan is a short term solution to a longer term goal. Some challenges included here are tighter timelines to execute and higher costs. You can expect to pay between 10 to 12% on rate and 2 points. Points are essentially a percentage of a loan. So if you hear 2 points, think 2%. Now, we kind of touched on this above, but your exits include selling the property to pay off the loan or refinancing it into a longer term loan. Another quick tip: when comparing financing options, do not just focus on the loan term. Be sure to ask about the prepayment penalty. Some lenders may offer a 3 or 6 month loan at a slightly lower upfront cost. While it might seem like a good move to save a little money, especially if you're aiming for a quick exit, things don't always go according to best case scenario. In my experience, the average hold time ends up being 6 months. And I've seen situations where borrowers chose a shorter loan term with another lender to cut costs, only to get hit with costly extension fees or default fees when timelines run longer than expected. That's why I typically think a longer term loan, like a 12-month loan with no prepayment penalty, often turns out to be the more cost effective and flexible option in the long run. Let's see here.
Jacqueline, can
All
I
right.
jump in with just a couple quick questions too? So,
Yeah.
uh, uh, I'm curious on how this works on new construction for Airbnb. I think that was the DSCR, I'm pretty sure. Is that a option for new construction for Airbnb, or is that a different product?
So we can do short-term rentals on DSCR. We personally want to see a 12-month history for short-term rentals. However, we can make exceptions on a case-by-case basis. So let's say you're very experienced in a specific area, you already operate 4 or 5 rental, you have histories on other properties, and you're buying a new construction. We can take that into consideration and use what's called AirDNA. I'm sure you all are very familiar with that, to make an exception to qualify for that program. So instead of using long-term rents, we could use short-term rents, but that is on an exception basis if there is no rental history.
And then, Kim, you're asking, just go back to DSCR real quick. Can that be taken over as a sub 2?
Meaning like an assumption, like if you were to sell the property?
I'm thinking you mean like subject to, yeah, that's what yeah.
Unfortunately, no, our loans are not assumable.
Great questions, everyone.
All right. So I think this is where I left off.
Yes.
So here's our next case study. This is a short-term bridge loan with renovation included, also known as a fix and flip loan. A little bit about our borrower. This borrower is an experienced investor with over 5 investment properties owned in the last 3 years. Investor experience here is an important consideration for most lenders when determining guidelines such as max leverage, down payment, and rate. We can also lend to new investors, but just as with the DSCR loan, having experience will play into having more favorable terms. The other most important part a lender will want to understand is the exit plan. For this property, the investor's plan is to purchase, renovate it, and resell it for a profit. Now let's get into the fun part, the loan details. We're going to use this for the next few slides to go over key calculations when penciling out your deals. First things first, the loan term. This investor opted to go with a 1-year bridge loan. At CB3, we don't have prepayment penalties on 1-year loans, which is what I was pointing out on the previous slide. This means if our borrower completes the project, sells, and pays off her loan early, she won't have any prepayment fees. So we can see our purchase price here is $730,000. This is our ARV, and our total loan amount is $742,000. I've also included some additional information here that we'll use, but how did we arrive at this loan amount and what do these figures mean? We went semi-easy into the calculations for DSCR, but this is going to be a little more math heavy. I've tried to break down the slides as much as I could to make it as easy as possible to follow along. So do not be shy to ask questions, which I don't think we're going to have any issues with today. So let's first start with how do we calculate the percentages based off of the data we currently have. So loan to purchase. Purchase of a property's purchase price that a lender is willing to finance at closing. To calculate this, you simply get the initial loan amount, divide that by the purchase price, and you end up at your LTP, which in this case is 88%. Now, LTP and LTV is used interchangeably here because the as-is value of the property matched the purchase price, which is often the case in real estate purchases. If this were a refinance, we would be dividing the initial loan amount by the as-is value for the LTV. One great takeaway here that I want to point out is the higher your LTP is, the less out of pocket. So in this particular case, since we're lending 88% LTP, the client is coming in with 12% down at closing. Loan to cost, percentage of the total project cost, including the price and the renovation that a lender is willing to finance. First, we need to understand how we got to our total project cost. It's a simple calculation. We just take the purchase price, add in the renovation to get your total project cost of $829,990. Now we're going to use this figure for our loan to cost calculation. You take your total loan amount, divide that by your total project cost, and you get your LTC of 89%. The takeaway here is that based off of this total project cost, the client is coming in with 11% between the down payment and the renovation. And then our last term is loan to after repair value, LTARV, percentage of the properties after repair value that a lender is willing to finance. We just take the total loan amount, divide that by the appraised ARV, and we get our LTARV of 70%. Do we have any questions on the terms? I don't think I see.
Yeah, can you go back one slide? I think Kim is asking if you just go back one slide. I'm not sure.
Yeah, I think is it this one, Kim?
Yeah.
Perfect.
Is there a hierarchy of importance when you have the LTP, LTC, and then you have the LTARV? Is there a hierarchy from a lender perspective? They want to see which one's more important. Are they equally important from a borrower
I would say
perspective?
they're equally important, but when we go into the slides, you'll see like Well, I guess it's not that they're not important. It just the way that I would do my calculations is I would start off with the ARV, right? We don't want to exceed 70% ARV, and you'll see why that kind of plays into effect with the other
Mhm.
calculations, because oftentimes that tends to be your most limiting factor. So I always like to start there. Um,
Yeah, if that doesn't make sense, then it's almost like the litmus test that nothing else is gonna, nothing else really matters if that doesn't actually pass the test.
Correct.
Yeah.
And they all play hand in hand. So you'll see how the numbers affect one another. Um okay, sorry, I forgot we were already here. Okay, so now let's dive into the numbers and break down how we actually arrived at our total loan amount. It's crucial to understand that the ratios your lender evaluates, while a loan officer may say they can lend up to 70% ARV or 90% of the purchase price, other factors can ultimately limit your loan amount. In this case, based off of the client's credit score and experience, they qualify for the following ratios, which I've highlighted in yellow. 100% of the renovation costs, up to 90% of the price, up to 95% of the cost, and up to 70% of the ARV. I do just want to preface this by saying that these calculations are meant to help you get a better understanding of deal structure. Your lender will be doing this for you when they're analyzing whether or not your loan will meet their guidelines. But if you're like me and you like to understand how numbers shift, this will help lay that out. Feel free to grab a calculator to follow along as we dive into the calculations. So I know I just said this, but from my experience, I found that the ARV tends to be the most limiting factor. So I always like to start there. So we're going to get our ARV, multiply that by the max that the investor qualifies for, which is 70%, to get our max total loan amount. Now, this figure right here is the max that we will lend between the initial loan amount and the renovation. To get your initial loan amount, you're simply going to subtract your renovation costs. So at CB3, we finance 100% of the renovation, which is why we're backing that out. So 742 minus 99 gets you to an initial loan amount of 642.10. Now, since other ratios can also affect your loan, we're going to make sure that we meet those requirements. The next one is 90% of price. We're just going to take our purchase price, multiply that by 90%, and we get a max initial loan of 657. Now we can see just in looking back at the previous formula that our initial loan amount that we previously calculated is less than our max initial loan amount, so this ratio is met. And now our last limiter is 95% of the total project cost. So we're going to take our total project cost, multiply that by 95% to get our max total loan amount. And once again, if we look back at our original calculation, we can see that the total loan amount that we had initially calculated is less than that. So this ratio is also met, which means our loan amount remains unchanged at the 742 that we originally calculated. Do we have any questions? I don't think I saw anything come through.
I don't see any. And just in summary, the part that you're mentioning about qualifies for 100%, qualifies for 90%, that
Mhm.
is due to two things: their credit score and their experience. Is that the two?
Correct.
Is there anything else that matters?
So there are other things that matter in terms of like rate, right? So your FICO will affect that, whether you're holding title to the property under a company name, under your personal name.
Okay.
We always prefer company. Your rehab level could potentially affect your ARV. Like we just actually released being able to go up to 75% ARV, which is great because if that was previously the most significant limiting factor, that just got bumped up. But that's for like cosmetic work.
Sure. Okay, great. We got do have a question here. What is the 742 to 9? Okay. Yeah, the 742, which you're highlighting, total loan amount, and then renovation costs called acronym. Is there an acronym for those two?
For which one? Sorry.
The total, oh no, 742 minus the 99. So the total loan amount minus the renovation cost. Is there an acronym for that?
Um,
Oh, she's saying never mind. She's got it.
yeah, okay,
It's
perfect.
part of
I
the
think she just did. Yeah, I know there are just a lot of calculations here. I initially had it as one slide, and then my marketing team was like, "You should break this up because this is a lot to follow," and so that's why we have multiple slides.
yeah, no worries.
Um, okay, so since our loan amount was easily determined by our first ratio, let's make it a little more complex and apply what we just learned. Let's say our ARV actually came in higher than expected at 1.1 million. What is the new loan amount? We're going to use the same case study to calculate this. So we're going to calculate our initial loan amount with the new ARV. So we're taking the 1.1 and multiplying that by 70% to get a max total loan of 770. Remember, this is the max between the initial loan and the renovation loan. So to get our initial loan, we're going to back out the renovation costs from the max total loan to get our initial loan amount of 670.10. But we have to check that against whether or not that's within 90% of the purchase price. So when we do that, 90% of the purchase price is 657, and we can see that 670 in this case is more than the 657 that we've listed here, the 90% of price. So we are actually restricted to using 657 because we're not going to lend more than 90%, at least on the initial loan amount. We're not going to lend more than 90% of the price. We want to see an investor come in with at least 10% down. So we have to update our max initial loan amount to 657. But we're not done yet. Remember, we still have to check that against our last limiter, which is our LTC. So we have to calculate our total loan amount with our new initial loan since that changed. So we're going to just add the renovation costs back in to our initial loan amount to get the new total loan amount of 756,990. And we have to check to make sure that's within the 95% of the total project cost. So we take the total project cost, multiply that by 95% to get 788, and we can see that the new loan amount that we had calculated, the 756,990, is less than this figure. So this ratio is met, our loan amount remains unchanged, and that is our final loan amount with this new ARV. Do we have any questions?
Okay, Elizabeth's asking too about, can you, will there be a calculator provided after the webinar to everyone, or
There
is there
will
any
be our
tools?
marketing team put together a PDF for you to use. We're just going over the calculations so you know how they interact with one another. But yes, you will be getting a PDF after the presentation as well.
Elizabeth, we got you. We got you. We know. So the questions that we all have. So great,
I
great
know it's
question.
a lot of math.
Like, hold on,
But
just give us a calculator. That would be great. But here's the deal, and here's the strategic part of all this. I just want to mention as somebody, as someone who's been investing for 20 years myself, it's great to have tools. It's great to have calculators. So all there with, totally agree with you. But understanding the thinking behind the calculations is really important as you're presenting deals to lenders strategically. So the thoroughness that you're going through, Jacqueline, is not just the nuts and bolts. It's actually the thinking and the way we present deals to lenders and to, to ensure, right, what are the right deals to present to this lender versus this lender. And it's the thinking behind it, I think, is so important that
exactly.
sometimes people are using calculators and honestly, they don't even know how to use those and they're not sure how to present them. So the calculator and tools are only as good as the input and the way we actually connect with lenders. So, and I think that the background you're giving is really helpful on that. So
Yeah, it's really just understanding the math behind the actual calculation. So the calculator will definitely help you get to these figures a lot faster, but just understanding how they affect another is important. So now that we have our new loan amount, let's actually calculate our final LTP, LTC, and LTARV. So just as a reminder, LTP is our initial loan amount divided by our purchase price, and that gets us to 90% LTP. LTC is the total loan amount divided by the total project costs to get us to 91% LTC. And then LTARV is our total loan amount divided by our appraised ARV to get to our LTARV. So tying this back to our original case study, the client's LTP was 88%, meaning she was coming in with 12% down. Now with a higher ARV, we can see that her LTP increased to 90%, reducing her cash to close from 12% down to 10%. I know this had a number of calculations, so I hope diving into the math gave you a clearer understanding of how the different values affect one another. And I'm going to say this one more time because I know the math can feel a bit heavy at first, but once you understand how lenders structure these deals, it really does become a powerful tool. It's about positioning yourself to get the best possible terms, whether that's reducing your out-of-pocket costs or making sure you're getting the full amount you qualify for across LTV, LTC, and LTARV. Each lender advertises differently, but a lot of them are saying the same or very similar things, just using a different term. One might say 90% of price, while another says 95% of cost. So this is going to help you compare different lenders as well. So we've reached the end of our presentation for today. Thank you so much for joining in. I really hope you were able to get at least a few key points from this. I'm here to help you in your business. So if you have any questions, please don't hesitate to reach out. My information is listed on the screen here. I've also included my social media if you'd like to connect with me there. Liz, I don't know if there are
yeah,
any
I'd
final
love to hear
questions.
takeaways, any other questions, anyone has any deals that they're working through right now that they have specific questions on. I think that would be great. And I'm sure that might be needed to be taken offline to answer certain things. But if there's any questions that are pertinent for any of you right now, that would be great to know. And number two, I'd love to hear in the chat, what's your one takeaway, as a result? And Jacqueline, as they're doing that, if you can put your contact link, so people can easily copy and paste it, that would be great, because it might be harder to do on the slide.
Oh, into the
Yeah, into the chat. That would be very helpful. But I'd love to hear from everyone. What is your one takeaway and action step that you're gonna do as a result of today, or just takeaway and action step would be great. Because there's whenever you're talking about structuring deals, there's a lot there, so it's very easy to for people just to do nothing, or this is interesting, but I'm going to go back to my other thing I was doing before I joined. We really want to encourage you to do something, even if it means running a deal by Jacqueline, what have you. That really makes a difference to put this into action. Really makes a difference. Okay, perfect. Thank you for doing that. Yeah, Kim is asking, what is the max percentage of loan for a DSCR?
So we can actually lend up to 80% loan to value, and that's on a purchase and a cash out refinance. Now, some states will be restricted to 75% LTV. That just happens to be like judicial states. But we can go up to 80% on both.
It's good to know, Sylvia. And then I want to go back to another question. Do you do DSCR on commercial properties 4+ units?
We don't know. We're limited to residential 1 to 4. But there should be a few lenders that can help with the 5+ multifamily.
Yeah, good
The one thing to note there is they usually have like a value per unit minimum. So make sure that you ask that. Like, I don't know if you're acquiring or if you're refinancing, but before you get under contract, definitely ask your lender if they have like a value per unit minimum.
This is an interesting question. You're a novice in this industry, but you're working on acquiring a small motel, excuse me, and that's a whole other asset class. Are you seeing, Jacqueline, any deals in that space? I'm imagining yes, because a lot of people are taking these small, maybe motels or facilities and converting them to Airbnb, and that's a trend I know people are doing. What are you seeing? Is there any input you can give there?
So we only focus on 1 to 4 residential units. So I actually don't see a lot of that.
That's a
However,
good
I do
point because
I
they're
do work with brokers that do a lot of
yeah,
commercial,
that's a good point.
right? So they do come to me asking about motels. So like one thing that I have seen is someone take like a motel and convert it to a multifamily instead, just because there's a better, I guess, value add from that perspective.
Yeah, no, absolutely. And that's the thing, is that you're never going to know everything about one asset class, right? It's really about the community. That's why we have Investor. And that's why I'm so excited to have you, Jacqueline, at InvestorCon. For everyone that is not aware, we are hosting our annual conference June 1st to 3rd. Jacqueline's going to be there. What I love about the conference, beyond the fact that it's 3 days, 25 speakers, all about really connecting, growing yourself, growing your business, growing your portfolio. But you're with women doing all different types of asset classes. And I know there's a lot of women who are actively investing in hotels and motels. But what's really neat, and to have women like Jacqueline there, bring deals. You're going to bring a deal. That happens at our conference. People are running deals by each other and really maximizing the time. It's not this transactional traditional conference. This is like deals are happening at our conference. These are serious women who are there to move their portfolio to the next level. That's what I love about it. I go to like, the pool, and these women are talking about a
Yeah.
deal and they're like, it is
No,
it. I'm
it
like,
it it is.
great.
It's really important. Like, at one of the conferences, we actually had, like a table to sit down and chat. I don't know how our setup will be here. But if you do have transactions that you're looking to finance, that is the perfect opportunity to sit with your lender and actually see what they do behind the scenes, right? Because like when you're on a phone call, you don't get to see how they're coming to your loan amount or to your terms. So I would highly suggest that you do come with deals. And even if you've already placed something, let's say you just closed with the lender, I don't know, a month ago, maybe still bring that scenario, see how things might have been different had you used, whatever lender you do find at the conference.
There's things that and personally, what I love to do is I always like to pick Jacqueline and lenders brains around geography. Where are they wanting to lend more to? That's a very interesting trend, because if they're looking to lend in a particular area or stay away from a particular area,
Yeah.
I like knowing that as an investor, because they know things. They're doing research that is like beyond what one investor is going to do. The other types of companies that will be there too is insurance companies. I want to know where they're looking to lend more, where they're looking to stay away from an insurance perspective. Those are two critical companies, and we'll have great resources for you at InvestorCon to quote unquote pick their brains of, because then you're like, okay, that's interesting. Didn't consider
Yeah.
that. So
Yeah.
would love to have you there, or it's me, Orlando, Florida, June 1st to 3rd. Um, great questions. Do something with what you learned. I think that's always the key with all of these particular but use lenders to really get a sense of your deal flow and running deals by them. Even if it's a template deal or a deal you found that maybe just you were going to make an offer, but just got swooped up by someone else, you can share, hey, this is the kind of deal that I'm looking to do more of. Do you lend to these kinds of deals? Even if it's not one you're necessarily going to purchase itself. I love doing that with lenders, because then you're able to see what their kind of appetite is, and then work with them as a partner versus just this vendor. They're a
Yeah.
partner with you,
Yeah. Highly
right?
agree. Yeah, instead of it being very like transactional, right? It's like you do have a relationship. Lenders are here to help you grow your business. So whether, it's one that you've already closed or one that you're looking to close, or you're in the middle of searching for a property, definitely bounce ideas back with lenders. Like I mean, the other thing too is I get to see what other investors are doing, so I can always tell you what I'm seeing from that perspective too.
Yeah. Absolutely. And to your point, if you can't help them and it's something that's an opportunity, then somebody knows someone. And that's why we have InvestHer, right? Because these are all resources. So you don't have to go figuring it out, but you have a trusted place to come. So thank you everyone for being on, for playing full out. I love the questions. I love the insight. Do something with what you learned. Jacqueline is here as a resource. Reach out to her. She's part of our Facebook community. She's always jumping in. I'm tagging her when I see
Yeah.
different things. So please know she's there for you. And I yes, so grateful to have you too. Thank you for saying that. We really uh try to do our best to put information in front of you that's going to support you on, again, growing yourself, growing your business, growing your portfolio. That's what we stand for all of you. So thanks for being on. Jacqueline, thank you so much for the great insight, getting our heads moving in really these calculations. The PDF that you reference, I know we'll do our best to get out to everyone that registered as a
Yeah,
follow-up to this. I know that's I saw actually that it's a very cool tool.
definitely,
So
definitely. Yeah, but I'm here as a resource. Thank you guys again for tuning in, and thank you for having me, Liz. This was
absolutely.
super great. I love that everyone was involved and asking questions, so that was awesome.
Absolutely. We're going to be doing some takeaways too from this webinar, and stay tuned. And everyone, I really would love to see you in June, but stay tuned for our next webinar, which is on our events page. So thank you everyone so much. Have a great rest of your day.
Take care,
Bye
guys.
everyone.
Bye.